This is Economy and Empire, where money, power, and empires reveal the hidden forces shaping our world. Today's story begins with a mystery at the heart of the global economy. Every nation is in debt, from the most powerful superpowers to the smallest developing countries. Governments everywhere owe trillions. But if the entire world is borrowing, a strange question appears. Who is the creditor? Who exactly does the whole world owe money to? And what if the global financial system was designed in a way that makes escaping debt almost impossible? Today, we uncover the financial illusion that keeps the world permanently indebted. How did a system emerge where governments, businesses, and individuals can never truly escape debt? Because behind the modern financial system lies a quiet illusion, one so powerful that it has shaped wars, empires, and the daily lives of billions, an illusion that makes debt appear temporary, when in reality, the system depends on it lasting forever. This is the story of the financial illusion that keeps the world permanently indebted, and once you see how it works, it becomes impossible to unsee. Setting the stage to understand the illusion, we have to go back several centuries before modern banking, before central banks, before paper money became the global standard. There was a time when money was simple: gold, silver, coins that had intrinsic value. For most of human history, money was something tangible. Kings could mint coins, but they could not simply create wealth out of thin air. But this began to change during the rise of European trade empires. In places like the financial centers of Amsterdam and London, merchants faced a problem. Trade was growing rapidly. Ships crossed oceans carrying spices, silk, and precious metals. But transporting physical gold for every transaction was dangerous and inefficient. So banks began issuing paper receipts for gold deposits. These receipts represented real gold stored safely in vaults. At first, the system worked exactly as intended. Every paper note could be redeemed for gold. But then bankers noticed something interesting. Most people never came back to withdraw their gold at the same time, and that observation changed financial history forever. The origins of the illusion: if only a small number of customers withdrew their gold at any given time, then the bank did not actually need to keep all the gold in reserve. It could lend out some of the deposits, then more, and eventually far more. This system became known as fractional reserve banking, a system where banks keep only a fraction of deposits and lend out the rest. Suddenly, money could multiply. One gold deposit could support multiple loans. Those loans became deposits in other banks, which issued more loans. And just like that, the financial system had discovered something extraordinary. Money could be created through debt. The more people borrowed, the more money existed in the economy. This created economic expansion on a scale never seen before. Trade exploded, cities grew, empires flourished. But hidden inside this new system was a quiet contradiction. If money is created when loans are issued, then money only exists because someone is in debt. The rise of the debt economy. By the late 1600s, governments realized the potential of this system. One of the most important turning points came in 1694, with the creation of the Bank of England. At the time, England needed money to fund wars. Raising taxes alone was not enough, but borrowing from a central bank changed everything. The government could issue bonds, the central bank could help finance them, and the economy could expand using newly created credit. Debt became a tool of national power. Countries that mastered finance could fund larger armies, build infrastructure, and expand global influence. This model spread across the world. Eventually, central banks appeared in nearly every major economy. Today, institutions like the Federal Reserve in the United States and the European Central Bank in Europe manage the global money system. But here is the crucial detail. Almost all modern money is created through lending. When banks issue loans, new money enters the economy. Mortgages, business loans, government bonds. Every expansion of credit increases the total money supply. But this creates a strange paradox, because loans must eventually be paid back with interest. The breaking point: this is where the illusion becomes visible. Imagine a simple economy with $100 in existence. A bank lends $100 to a borrower, but the borrower must repay $110 with interest. Where does the extra $10 come from? It must come from new loans issued somewhere else in the system, which means, for all debts to be paid, the system must constantly create more debt. The global economy therefore depends on continuous borrowing. If borrowing slows, growth slows, businesses fail, unemployment rises, financial crises appear. This is why recessions are often triggered by credit contractions. When banks stop lending, the money supply effectively shrinks, and the illusion begins to crack. One dramatic example occurred during the Great Depression of the 1930s. Bank failures wiped out deposits, credit collapsed, the economy spiraled downward. Governments learned a painful lesson. The debt system must never be allowed to stop expanding. The fallout after the Second World War, global finance entered a new phase. Governments expanded welfare systems, infrastructure, and military spending, all of it financed increasingly through borrowing. For decades, economic growth helped manage the debt burden. But another turning point arrived in 1971, when Richard Nixon ended the dollar's convertibility into gold. This effectively ended the Bretton Woods system. For the first time in modern history, the global monetary system became entirely fiat. Money was no longer tied to gold, it was tied to confidence and credit. From that moment forward, debt expanded dramatically. Governments borrowed more, corporations borrowed more, consumers borrowed more, and central banks gained powerful tools to stimulate the system: lower interest rates, bond purchases, money creation. Each crisis triggered even larger interventions. The financial system had become dependent on perpetual credit expansion. Modern parallels today, global debt has reached staggering levels. According to international financial institutions, the world now carries over $300 trillion in total debt. That is more than 3 times the size of the global economy, and the pattern is repeating everywhere. Governments run chronic deficits. Central banks create liquidity. Asset prices inflate, then eventually bubbles form. We saw it in the 2008 global financial crisis. An explosion of mortgage debt created an enormous housing bubble. When borrowers defaulted, banks collapsed and markets crashed. The solution: more debt. Central banks launched massive stimulus programs, interest rates dropped to historic lows, and global borrowing surged again. Even the COVID-19 pandemic triggered the largest financial intervention in modern history. Trillions of dollars were injected into the global economy. The system survived, but the debt grew even larger. 3 takeaways. So what does this story reveal? First, modern money is largely created through debt. Without borrowing, the money supply cannot expand. Second, the financial system depends on continuous growth of credit. If borrowing slows dramatically, the system risks instability. Third, debt has become the foundation of modern economic power. Governments, corporations, and households are all part of the same structure, a structure that appears stable, but relies on permanent expansion. Final thought, and that brings us back to the original mystery. If every country is in debt, who is the creditor? The unsettling answer is this: in many ways, the system itself is the creditor. Debt circulates through banks, governments, and investors in an endless loop. Money creates debt. Debt creates money, and the cycle continues. The illusion is not that debt exists. The illusion is that the system was ever designed for it to disappear. Because in the modern financial world, debt is not a temporary problem. It is the engine. If you enjoy uncovering the hidden forces behind money, empire, and economic power, make sure to subscribe to Economy and Empire. Because the deeper you look into financial history, the more you realize that the biggest stories shaping our world are the ones most people never see.